Oh, there are so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless.
Hello and welcome. Today, we're diving into a topic that's both complex and absolutely crucial: how to manage your Canadian source income after you've become a non resident for tax purposes. There's a common misconception that once you leave Canada, your tax obligations to the country are completely finished. But in many cases, that couldn't be further from the truth. So, how do you navigate this landscape? Let's break down the rules you really need to know.
So here's our game plan for this explainer. We'll kick things off by getting crystal clear on what it actually means to be a non-resident in the eyes of the tax authorities. Then we'll look at the different kinds of Canadian income and the automatic withholding tax that gets applied. From there, we'll jump into some practical, real-world strategies for managing everything from pensions and rental income to your investments and any work you might do in Canada. And finally, we'll tackle the two big ones, selling property and owning a corporation, before we wrap it all up with the most important takeaways.
All right, first things first. It's absolutely essential to understand that your tax residency isn't just about your physical address. While that's certainly a factor, the Canada Revenue Agency, or CRA as we'll call them, looks at a much wider range of your ties to the country. So, what exactly is a tax non-resident? Well, to put it simply, it's a status the CRA gives you when you've severed enough of your residential ties that Canada no longer has the primary right to tax your worldwide income. But, and this is the most crucial part of this section, becoming a non-resident does not wipe out your obligation to pay Canadian tax on any income that still comes from a Canadian source.
And that leads us right into the core of our discussion today: the income you might still be generating from Canadian sources, and the default tool the CRA uses to tax it. It's called a withholding tax.
So what kind of income are we talking about here? Well, it's a pretty broad list. It includes things like your government and private pensions, any rental income you're getting from properties in Canada, and dividends from Canadian corporations. It also covers interest from Canadian investments, income you earn from working in Canada temporarily, and, of course, the big one, the proceeds from selling Canadian real estate.
So, how does the CRA go about collecting tax on all this income? They use a withholding tax. Now, this isn't some strange new concept. It's exactly like the income tax that gets deducted from a regular employee's paycheck. The person or company paying you, whether that's your pension plan, your tenant, or a corporation, is legally required to hold back a piece of that payment and send it straight to the CRA for you.
And here's the number you really need to remember: 25%. That is the flat, default withholding tax rate for non-residents, and it's applied to the gross amount. That can be a really significant financial hit, which is precisely why understanding how to manage it, and hopefully reduce it, is so important. Think of this 25% as the main challenge we're trying to solve.
All right, let's move from the theory to the practice. We'll start with two of the most common income sources for non-residents: pensions and rental income from Canadian properties. For both of these, there are specific strategies you can and should use. For managing tax on your Canadian pension, you really have two different paths. The first approach is proactive. You use Form NR5. This is an application you send to the CRA to get your withholding tax reduced right at the source, often lowering it from that 25% down to a treaty rate, like 15%. The second path is reactive. It's called the Section 217 election. This lets you file a Canadian tax return after the year is over to try and get a refund for any excess tax that was withheld.
Okay, let's look at another very common scenario. Imagine you own a rental property back in Canada. As a non-resident landlord, your tenant or property manager is legally required to send 25% of the gross rent, not your profit, the total rent, directly to the CRA every single month. So how on earth do you manage that massive cash flow problem?
Well, you have two primary tools here, and they're quite similar to the pension strategies. The proactive option is to file Form NR6. If the CRA approves this before the year starts, it allows the withholding tax to be calculated on your estimated net rental income after you subtract your expenses. This makes a huge difference to your monthly cash flow. The catch? You have to appoint a Canadian agent. The alternative, reactive approach, is to let the 25% on the gross rent get withheld, and then file a Section 216 return at the end of the year to claim all your expenses and hopefully get a big refund.
Next up, let's take a look at investment income and money you might earn from working in Canada.
The same basic principle of a withholding tax applies, but the specific forms and rules you need to follow are a little different.
For investment income, the key document you need to know is Form NR 301. If you're receiving dividends, you file this form with your financial institution to claim a reduced withholding rate based on the tax treaty with your new country. For example, the Canada-US treaty brings that rate down from 25% to 15%. For interest income, like from a GIC or a bond, the news can be even better. It might be completely exempt from withholding tax, as long as it's paid by an arm's-length party. You'd file that same Form NR 301 with your bank to claim the exemption.
Now, what if you're a self-employed person who comes back to Canada to perform a service for a client? Well, under something called Regulation 105, your Canadian client has to withhold 15% of your payment. It's also worth noting there's a special higher rate for professional artists and athletes. They face a 23% withholding tax.
The really important thing to understand here is the difference between being an employee and being self-employed. If you come back for temporary employment, your employer can apply for a Regulation 102 waiver to stop those payroll deductions from happening. But for self-employment, that 15% tax has to be withheld, and your recourse is to file a non-resident tax return later to claim your business expenses and try to get a refund.
Okay, we're now getting into the big leagues. These next two topics, the sale of Canadian real estate and the ownership of a Canadian corporation, are often the most financially significant and complex situations a non-resident will face. Selling property as a non-resident is a multi-step compliance process that requires very careful timing. It all starts with the buyer's lawyer, who is required to hold back 25% of the entire sale price. To get that money released, you have to apply to the CRA for what's called a certificate of compliance. This involves calculating and paying a 25% tax on your actual capital gain. Once the CRA issues that certificate, the lawyer can release the held-back funds. And the final step is to file a special Section 116 tax return to settle your final tax bill and maybe even get some of that money back. And for all the business owners out there, please pay close attention. Becoming a non-resident while you still own your Canadian corporation triggers a critical and very costly change in its tax status. This is one area where getting professional advice is not just a good idea, it's absolutely essential. So just how big of an impact are we talking about? It's huge. Your corporation loses its special status as a Canadian-controlled private corporation, or CCPC. The result? The corporate tax rate on its active business income more than doubles, jumping from around 12% all the way up to about 26%. And on top of that, any dividends your company now pays out to you will be hit with that 25% non-resident withholding tax.
I know that was a lot of information, but every piece is incredibly important. So let's take a moment now to distill all of this down to the most important points that you really need to remember as you navigate your Canadian tax obligations from abroad.
And I want to leave you with this critical piece of advice. When it comes to tax compliance, ignorance is never a defense. The responsibility to understand and meet these obligations falls squarely on you. "I didn't know" is never an acceptable answer for the CRA. So what's your action plan? First, be proactive, not reactive. Use forms like the NR5 and NR6 to manage your taxes in real time, not a year later. Second, truly understand that your Canadian tax file isn't closed just because you've moved. Third, remember that each type of income has its own specific set of rules and forms. And finally, please recognize that for complex assets like real estate and corporations, professional, personalized advice isn't just recommended, it is absolutely essential. And we'll end with this question. Now that you have this framework, are you truly prepared? Because as we've seen, navigating these rules requires careful attention and forward thinking. Proactive planning is not just an option, it is an absolute necessity. Thank you for your time.